Up in the morning and out to school. The teacher is teaching the golden rule. American history and practical math.
What is that golden rule?
You study them hard.
Ladies and gentlemen, listeners out there, we're back, and we're here to talk about your money. More importantly, about your money and how to keep it. The show will be for 2 hours. It's live. We have a special guest and much, much more. I want to talk about how to keep your money. They don't teach you that in school. They teach you how to make it, but they don't teach you how to keep it. And it's not really about how much you make that counts. It's about how much you keep. So at the end of the day, you go out, you make your paycheck, you take it home, and most people, by the time they get paid, by the time that payday is over, they are broke. They spend 100% of everything they earned, and they have nothing to put away for themselves. This show is about how you can keep more of your hard-earned dollars. Again, at the risk of being boring, I repeat these statistics over and over and over again. Take 100 people who started equal today at the age of 25. By the time they end up at 65, 1 is wealthy, 4 are well-to-do, 5 are still working, 36 have no more problems because they're dead, and there's 54 left over. They're dead broke, dependent on family and state, and that's because they do not have a written financial plan. I think that's the fundamental reason why everybody fails financially. So the 10 scrolls we talk about today, I begin a new life. So let's just go to the first affirmation. Today, I begin a new life. Time to get a financial plan. That's a new life. How do you get one? You make a phone call. Best way to get one, phone 604-737-3512 and speak to Frida. Or if you're long distance, it's 1-800-661-1495 and speak to Frida. If you have any questions or comments, you want to participate in this radio show, we give stuff away to all people who call the show. The number here is 604-280-0650. If you're calling long distance, it's 877-280-0650. Repeat that once again, 604-280-0650. Long distance, 877-280-0650. If you just tuned in, I'm certified financial planner Fred Snyder, also registered financial planner representing Scotia Wealth Management. Used to be Scotia McLeod, and we are a financial department store. You can get virtually any financial product through our organization. We're independent financial advisors, providing everybody with a written financial plan, a written analysis of their investment portfolio. You want to get one of those, all you have to do, once again, make a phone call. 604-737-3512. That's Frida down at the office. Or 1-800-661-1495. You want to talk to us live, 604-280-0650. Long distance, 877-280-0650. So I think that the fundamental reason why people fail financially is they don't have a financial plan, but they also don't have an investment plan. They don't have the best products in their financial portfolio. Now, I see 4 or 5 personal financial profiles on a daily basis, 4 or 5 appointments almost every day. And I see what these people have, and they come in, and they do not have the best funds in their portfolios. Joining me on the line today is Craig Miller, representing No Rep Mutual Funds from Toronto. And we're going to talk about the No Rep group of funds. There's many funds out there. There's thousands of them to pick from. But I'm going to talk to him about why one should pick the No Rep group of funds for investment products and the returns that those funds can provide and the expected rates of return that you can expect from those funds. So, Craig, welcome to the show. Are you there, Craig? Hello, Craig. It looks like we don't have Craig. We have some kind of a technical problem on the lines. Excuse me for a sec. We're trying to work it out here. I'll just pull up the No Rep information. Got a problem here. Do we have Craig Miller on the line right now? We don't have Craig Miller on the line. I don't know what's going on. Not a good day. Okay, so anyway, the bottom line is that everybody needs to have the best investments in their investment portfolios. and I find that that is not the case. And it makes it very, very difficult for people. So I'm going to pull up the information from the no-rep group of funds while we're waiting for Craig Miller, where I can discuss all this with him. So here's an overview of the no-rep mutual fund family. No-rep mutual funds aim to bring efficiency to inefficient markets. So right off the bat, in the first line, they're saying that the markets, stock markets, etc., are not efficient. And that's true. Our well-designed investment solutions target market segments where active management truly counts due to companies being under followers, undervalued, or simply misunderstood. So they're the investments that they try to pick from. Our guiding principles influence the funds we create, so they create their own funds, and the way we invest. They're really a wholesaler. We manage risk by not overpaying for growth. In other words, they try to buy value. They're value investors like Warren Buffett. And again, the issues go on and on. But I'd rather Craig Miller tell us about all this rather than me. That's why I got him on the line. Hopefully he's there now. Craig, are you on the line?
I am. Good morning, Fred.
Oh, Craig, we had trouble getting through to you, so sorry about that.
That's okay.
I'm going to get my volume up a little bit here. So I want to know, Craig, first off, might be a good idea for you to introduce yourself in terms of your relationship with no-rep funds. Okay,
Sure.
So let's start there.
Sure. So I'm the chief investment officer at NOREP Funds.
So you're the head honcho.
That means I oversee the research department anyway.
Okay.
Yeah. So I've got over 19 years experience in the industry.
Mm-hmm.
I started at a large fund company, early in my career, and I was a global equity analyst and then a global equity fund manager there. And that large fund company we sold to one of the big banks here in Canada. And after that, a couple years after the sale, I decided I wanted to do something a little bit more entrepreneurial, and NOREP was looking for a global equity fund manager, so it was a great match. So I joined the company in 2005. And we've grown, the company has grown very rapidly. To give you some numbers, back in 2001, we had about 28 million in assets under management, and today we're at over $1 billion 15 years later. So it's been a good growth story at our business. And even in terms of headcount, back when I joined in April of 2005, we had 13 people at the company, and now we've got 43. So in addition to being the chief investment officer, I manage all of our global equity mandates. So I'm the manager who picks the stocks outside of Canada in the funds that we have that invest outside of Canada.
So when it comes to the global markets, you're the man.
Well, I guess you could say that, yes.
Okay. All right. Now look, you got a bit of a funny name there. Would you want to explain that name?
The name of the company?
Yeah.
Yes. So it's very simple. The name of the company, of course, is NOREP, and it's as simple as the co-founder's surname is Perron, and NOREP is just Perron spelled backwards.
Okay. Because I thought it kind of meant no rep.
No, it's quite the contrary. We investment advisors are our partners, as are our individual investors of those investment advisors. So it's definitely not a no-rep business. A no-rep business. It's NOREP is simply the name of the founder spelled backwards.
And your investments that you offer are offered pretty much by the independent part of our industry, and I'm talking about the banks, the brokerage firms, etc. Correct?
That's correct. So we would use investment advisors across Canada to, I guess you could say, distribute our products. Mm-hmm. So people typically don't open an account directly with us. They would go through some kind of an investment advisor, either a planner or a financial advisor or what have you. As I say, we're available in all areas of Canada except Quebec, and we'll actually be in Quebec shortly. So after that, we'll be across Canada.
So tell me something then. How does your firm differentiate from other firms that are out there? In other words, like CI funds or Mackenzie funds or the Investors Group, et cetera, et cetera, et cetera.
Yeah.
How do you? What makes your firm different? Why should I offer your products as opposed to some other firm?
Sure. Well, that's a great question. So there's a few things that we do really differently than the rest of the industry in Canada, we think. Number one, we typically only participate in areas of the market that are very difficult for either investment advisors or individual clients to do themselves.
Like fixed income funds.
Like fixed income funds. However, you have to differentiate there as well, because in fixed income, it's as you know, it's pretty easy for a client to buy a government bond.
Not too hard at all.
You could just telephone your investment advisor and say, "I'd like to buy, this government bond of this matures on this date," and away you go. It's easy to transact. However, if you want to buy, if an individual wants or an advisor wants to buy a credit-sensitive bond, in other words, a bond issued by a company,
there's credit risk.
That's not always easily done, because there's often what they call market makers in the marketplace that would deal in that bond. And so if a financial advisor doesn't work at the company that deals in that bond, it can be extremely difficult to transact.
You might be talking about a high-yield bond fund or something
high-yield
like
bond,
that.
for instance. Or even like a Rogers Cable type of a bond. There's only certain bond trading desks that deal in that issue, so it's very difficult for an individual to transact. And if you're an advisor who doesn't work at one of the banks that transact in that bond, then it's difficult as well. So we do that. So we deal with every bond trading desk, and so we can buy any credit-sensitive bond that we want because we have all of those relationships. So again, difficult for someone to do themselves. A government bond is easy for someone to transact. We don't have a government bond business. We're not in government bonds. It's too easy for people to do themselves. They can do it cheaply via ETFs, et cetera. So we just don't bother with that part of the market.
So what bonds do you participate in?
So a second part of the market that we would participate in might be investing in small companies. So a little known fact about us is if you look back to April last year, in 2015, we had the number one performing mutual fund in Canada over the trailing 15-year period of any asset class. There was no fund in Canada that had a better fund than us, regardless of asset class.
And what was the name of that fund?
And that is our original NORAP fund.
Okay.
That's our flagship fund. And at that time, it had a 15-year annualized rate of return of around 17%, I think it was.
Okay. I don't know how many of our listeners can see the screen that I'm looking at right now, but I have your webpage up. And I'm looking at your mutual funds, and the number one fund on the list is the NORAP fund.
It's the original NORAP fund.
I can click that and open that up if I want. I'm not going to go there right now, but I have a list of all your funds. I also have Morningstar Advisor Workstation loaded up with all your funds on there, so I can look up almost any fund in seconds.
I see.
But basically, I'd prefer not rather than do that. Just have conversations about what you have. So you're telling me that the NORAP fund was the top fund. Right. Is it still?
Well, I think there might be 2 or 3 ahead of it, something like that. I actually haven't checked that in a few months. But last year at this time, we ran advertisements across Canada in a limited way, letting people know about that. And so it's an odd part of this industry that we would have the number one performing fund in Canada over that 15-year period, and yet we're not a household name. But that's what we're actually proud of that in a way, because we think we're a very well kept secret, and we think that our clientele that have found us have found something unique and different and special, and for the people that have been with us for a long period of time, they've done extremely well.
How many funds do you fellows have?
We have about 14 at this time, and so there's a variety of different mandates in Canada, in the U.S., in international markets, in fixed income, and we have several hedge funds as well, which are offered in a different manner. But that's basically our product lineup. We also manage flow-through shares, so every year we do a flow-through offering, which is a tax and advantageous way of investing in the energy industry.
Okay, I have my Morningstar Advisor Workstation loaded up. Your top performing fund over the last 5 years is NORAP U.S. Dividend Plus Class Fund.
Yep.
Let's talk about that fund. That's your number one performer over the last 5 years.
Okay, so over the last 5 years. Now I have a very small part of managing that fund. We actually have a fund manager that is in our Toronto office, who is the lead manager of that. So his name's Cameron Kahn. So Cameron would be the best person to talk a lot about that fund. But just in general, our U.S. fund has been a very strong performer over the last 5 years. And it's obviously not a coincidence that the U.S. stock market has been a very strong performer over the last 5 years as it recovered from the global financial crisis. And what has also fueled returns in a lot of investments outside of Canada is, of course, the much weaker Canadian dollar. True, it's perked up a little recently, but that explains the performance of that U.S. Dividend Plus fund. We've managed that extremely well, we think. It has a great combination of small, mid, and large-sized companies that pay a meaningful dividend, and that distribution is paid out to unit holders. And in addition, of course, the market that it invests in has been strong, the U.S. market, and the Canadian dollar being weak. All those things combined have helped that fund perform quite well over the last 5 years.
$10,000 invested in that fund 5 years ago is worth $17,454 today.
Right. So that's in the current environment.
That's pretty good. That's good performance. It's excellent.
Yep.
And I don't see any negatives on it at all over the period.
Well, I think longer term that the U.S. market is a very, very good asset class. That if you take the S&P 500, that index is very well diversified. You've got meaningful representation of all the 10 major segments of the marketplace. Mm-hmm. It tends to be less volatile, that market, than most other markets in the world. Mm-hmm. And of course, you have some of the world's greatest companies that are in that, say, take the S&P 500 index or in our fund, that help fuel those gains over the medium term.
Mm-hmm. The numbers I just put out there just now are after MER, but the MER in that fund, according to Morningstar Workstation, is 4.89. That's pretty high, isn't it?
It is. Now, on some of our funds, we do have an incentive fee, so we try to operate in areas of the market, as I say, that are much more difficult for people to do themselves. We also do a lot of investing in particular companies or segments of the market that people either can't or won't do themselves. And so because of that, in some of those funds, we have an incentive fee, which when things go well, that can make the MER high. And if things don't go well, of course, you don't earn those incentive fees. But we have lots of low-cost options to invest
I understand that, yeah.
at our lineup as well. So
these are the kind of questions I would get from clients, that's all. So.
Absolutely. But it's a bit like, everybody wants low income taxes, but, the best way to pay a lot of income taxes is to make a lot of money, and the best way to pay low taxes is to not make much money. So
you got it. That's exactly right.
There's an element of that, too. If you're successful, typically things like that go up.
Okay, so that particular fund, since inception in December of 2005, has averaged 6.36%.
Yep.
So that's a period greater than 10 years, and that's a pretty good rate of return.
Well, when you consider you have a Canadian dollar which appreciated quite a bit leading up to the financial crisis, then you had the global financial crisis where markets were down a significant amount, and of course since the financial crisis, at least the peak of it or the epicenter of it, the markets have recovered quite a bit. But I think that just goes to show investors that this is a long-term game. It's a marathon and not a sprint. And if you get hung up on what did a certain fund or a certain market or even a certain stock in a lot of cases do in the last 3 months, and I better make a change accordingly because of recent performance. Mm-hmm. This is we're in a long-term a game here. It's really not a short-term game, even though obviously a lot of people spend a lot of time focusing on the short term.
Yeah. So essentially, as a financial advisor, the biggest problem that I have is that I want to put, for most of my portfolios, most of my client portfolios, I want to put 40, maybe 50% of the money, maybe even more than that, into fixed income securities and the balance in equities. So I have to pick various sectors to invest on the equity side and various types of bonds to put on the fixed income side.
Yeah.
And I'm talking long-term government bonds, I'm talking short-term corporate bonds, I'm talking high-yield bond funds. I use the word duration as a way to measure how much risk is in a bond, because some people think, well, it's a bond, there's no risk. Well, there is market risk in a bond, and there's credit risk if companies go broke, et cetera, et cetera.
Yep. So
the challenge for me is when I have to put 40% of a portfolio into fixed income securities, that's pretty hard to do these days, isn't it?
Well, it is, Fred, and you're bang on, and you are grappling with what most investors around the world are grappling with, and that is the lack of compensation currently being offered to invest in government bonds virtually anywhere you go to around the world.
And every pension plan that's out there must have the same problem.
Well, absolutely, and there's a whole bunch of knock-on effects that have happened because of that. So what has happened? Well, look at commercial real estate. I mean, I don't have to talk to people in Vancouver about what's happened in residential real estate in Vancouver, but let's set that aside. Let's talk about commercial real estate. So commercial real estate, one of the most famous commercial real estate investors, Sam Zell, said recently that commercial real estate is fully valued basically in all developed markets around the world. And the reason it is fully valued is because, of course, if you own an office building, for instance, or a shopping plaza, that has a yield because you get rent from your tenants, you pay your interest and your loan amortization and your costs, and you get a yield that's left over. And that yield historically has been much more attractive than government bonds, and so big pension plans have all rushed to things like real estate and infrastructure and all of these areas to try to get a better yield than they can get from government bonds. So that has driven the price up of those types of assets, and of course the yields down. So if you look at a place like Switzerland today, if you invest in a 10-year bond in Switzerland, the interest rate is negative. So you have to pay Switzerland for the right to invest in their 10-year bond each year. But minus 0.4% is the yield.
Ouch.
So, but people are willing to do that. Certain segments of the investment landscape, institutional landscape, are doing that because they think the yield might go even a little lower. So they think that they'll still make a profit by buying that now, or they're just willing to pay that, almost like a form of insurance to make sure their money is held safe. So that's the extreme situation that we're in right now. There's a whole bunch of other knock-on effects, and we can talk about them if you like, but it's very difficult for individual investors today to get that shock absorber in the portfolio that they've typically had by having a meaningful portion of the portfolio exposed to government bonds, because you're just really not being compensated adequately for that.
Yeah. You need fixed income inside the portfolio to mitigate volatility.
Absolutely. Yeah, you're absolutely right. And so that is why people have looked for all these alternatives, real estate, or another example is consumer staples companies. So the large food companies, or like a Costco, or the companies that have very, very predictable revenue and earning streams, because they almost they call them people that have just moved out of the government bond markets because the compensation is not there, the yield is not there. So they go into other areas, such as the stock market, but they'll go to the more conservative portions of the stock market to try to get a yield that way.
Okay, so here's the question. It all leads up to this particular question. I want to build, I want to engineer, I want to create, I want to put together a portfolio that's balanced. And for the sake of clarity, let's say that I want 40% of that portfolio to be in fixed income securities and the balance in equities. The equity side for me is reasonably easy, because I'll pick funds based on 5-year track record, and that's really easy. It's easy to find them. Yeah. But when it comes to the fixed income side, it's getting pretty tough. Yeah, so you are a portfolio manager, and you've managed money, and I know you really darn well know what you're talking about. So what would you recommend that I choose for fixed income that's out there?
Yeah, so on the fixed income side, I think what I would suggest is you'd have to tilt the portfolio, the fixed income part of the portfolio, into more, let's call them credit-sensitive areas. So things like investment grade or even high-yield fixed income securities. You maybe want to have some in government bonds, again, just as that shock absorber. But, even in Canada, if you buy a 10-year government bond here in Canada, the yield currently is 1.26%.
That's terrible, I know.
So if inflation is, if inflation, say, over the medium term, 2.5% in a developed economy, you're actually losing money after inflation. Your money's worth less 10 years from now than it is today. So, but nevertheless, it is the shock absorber. It performs well in market downturns, et cetera. So, I focus on global equities. Okay, that's my day-to-day
I know that, yeah.
job. But maybe if you're talking 40% fixed income, maybe you have 10 or 15% in government bonds, or maybe you have 5 or 10% cash and a little bit in government bonds, and the rest I would allocate towards either high yield or investment grade securities.
I'm going to ask you this question. I won't say the name of the company because they're a competitor of yours, but there's a company out there that has a high yield emerging markets fund.
Yeah.
That's got really good numbers. What are your comments on that?
So I like that asset class. I like that asset class over the medium to long term. In the short term, what's happened with a lot of emerging markets countries is they're struggling a little bit in terms of growth. We all know China. We hear about China every day, about how growth is slowing down and the currency is weakening and so on. But the issue currently with emerging markets, whether it's debt or equity, is emerging markets typically never perform well when the U.S. Federal Reserve is hiking interest rates. Those economies never perform well when the U.S. dollar is strong, and they never perform well when commodity prices are weak. Okay? And we have all three of those things happening right now.
Exactly.
Does that mean you never want to own those asset classes ever because of what's happening right now? No. But you have to be very careful because those types of economies thrive when the opposite is happening. Now, if we look at what's happened in the marketplace currently, we can see that commodity prices have gone up a little bit recently. We can see that in December of 2015, investors, professional investors as a group, thought the U.S. Federal Reserve would hike interest rates 4 times this year.
Sure looked that way, didn't it?
Yeah, now people say once or maybe twice at the most. So that means interest rates aren't going up as fast as people thought even a few months ago. And then the final thing is U.S. dollar strength. I mean, we all know as Canadians with what's happened with the Canadian dollar so far this year, that the U.S. dollar is not as strong as it was, in the fourth quarter of last year. So, in other words, the prospects for emerging markets, both debt and equity, look a little bit better today than they did, 3 or 4 months ago. But the nice thing about emerging markets debt, we like that asset class. We don't have an offering there currently, but we like that asset class. And the nice thing about that is you can typically get exposure to government bonds that have yields that are much more attractive than what you can get in developed markets. Now, there's associated risk with that, too, of course, and currency risk and so on that you have to manage. But, by and large, I like that asset class.
Well, that's good news because I just picked one of them for one of my model portfolios the other day.
Yeah.
That confirms that. So what fixed income, if any, products do you have in your stable of funds right now that would be well placed in a model portfolio?
Yeah. So we have 2 that come to mind immediately in terms of that are in mutual fund format, so they're easy to buy, it's easy to transact, easy to sell, easy to track performance, all of that stuff. One is called the Short-Term Income Fund, and another is called our High Yield Fund. So our High Yield Fund is a portfolio that invests in a combination of high yield bonds, senior secured loans, and also some investment grade securities as well. So that's a good mix of longer-term fixed income securities that give you this balanced portfolio in the credit-sensitive part of the fixed income markets that can get you a higher return than what you'd be able to get, much higher return than what you'd be able to get in the government bond market over a medium time frame.
What would be the expected return over 5 years?
Well, that's kind of tough to say. It's a bit like, what's the expected return in the stock market over 5 years? We can take our guesses, but I think for that portfolio, you'd want to take a look at the internal yield of the portfolio. So the current yield of that portfolio is about 7.4% as of the end of February. And the yield to maturity, in other words, the yield that you'd get if you held all those bonds to maturity in the portfolio, is actually about 9.
Yeah, 9.
Okay?
Well, that's actually pretty good, isn't it?
So obviously a heck of a lot more attractive than the 10-year government bond yield in Canada.
Or a 2% GIC.
Yeah, or a 2% GIC, that's right. Now, of course, you have to take the subsequent risk associated with that. It's credit sensitive, so when the economy is doing really well, those bonds tend to do extremely well. Mm-hmm. When the economy is not doing as well, the volatility of those bonds can increase. But remember, when you look at a corporate bond, bonds rank ahead of stocks or the equity in the event of a downturn or a bankruptcy or liquidation or something like that. So the bondholders get paid first.
Just elaborate on that.
Okay, so it's just like the best way to explain it is if someone has a home and it's Vancouver, so let's use $1 million for the price of a home in Vancouver. So let's say that home is 50% owned. There's 50% equity in the home, and there's a 50% mortgage against that home. Okay, so the homeowner has $500,000 in equity in that house, and the bank owns effectively $500,000 of that house. If the market were to correct, and I'm not suggesting this is the situation, we're just using this as an example. If the market were to correct and it were to go down 50%, so that $1 million house is now worth $500,000. The equity in that house is worth $0, but the bank still gets their $500,000 back if they force the homeowner to sell.
They get paid first.
That's right, and that's no different than a high yield bond. If there's equity in that company, and things go wrong, then the bondholders get paid first, and often your recovery in a distress situation is obviously much better than what a stock would get. So if you have a collection of high yield bonds that have stocks to trade in the marketplace, then in the back of your mind you can say to yourself, well, as long as there's equity that trades in the marketplace, those bonds are probably worth quite a lot of money because the equity holders take the hit first.
Yeah, it's like if we go back to 2008, when we had all the credit difficulties and the automobile companies were bankrupt, technically. Yep. And they were selling bonds back then, and it'd be the same thing. It would. But now let's look at the other way. So we talked about the downside, what if there's a problem or what have you. But let's look at the upside. And again, let's go to that simple example of the $1 million home in Vancouver that's got a $500,000 mortgage against it, and there's a $500,000 in equity. What if the price of that house goes up 50%, goes from $1 million to $1.5 million? Well, how much has the bank made if the house goes up in 50% in value overnight? The bank makes $0, right? The bank still only gets the $500,000 loan against the house. Yep. The homeowners doubled their money because their equity in the home has gone from $500,000 to $1 million. So when you have a growing economy, obviously equities do well because things like that happen. And but the bank is still good. The bank is in even better shape because there's more equity in the home than there was before that price gain. So it kind of works both ways. They're in the lending business. They make money off of the interest, not on the equity itself. Absolutely. But remember, Fred, that's just like the high yield bond investor. They make money off the interest in that bond. They don't make money off the appreciation of the equity in the company. It's That's correct. Yeah. So you mentioned high yield bond. You actually mentioned another type of bond. What was that? Well, there's something called a senior secured loan. And keep it as simple as possible. When you have a high yield bond of a corporation, typically what happens is, again, let's keep this as simple as possible. Say it has a yield of 8%. So if there's a $100 bond outstanding, you get $8 a year. That would be your coupon, $8 a year, regardless of what happens with interest rates over the life of that bond. Now, with senior secured loans, they have a floating rate of interest. So they typically, as an owner of that loan, you would typically get a yield of whatever the government bond yield is, plus some kind of a spread. So if the government bond, say the 5-year government bond yields 1%, let's say, and the spread in the marketplace is around 6%, you take 1% government bond yield plus the 6% spread to get to a 7% yield. So loans typically give you a lower return than a high-yield bond would. However, they're much less volatile because they don't go up and down when interest rates go up and down, right? Because your bond adjusts. The compensation you receive as a loan holder adjusts depending on what's happening with the marketplace. It's tied to the bond. The price of the bond adjusts depending on what's happening with interest rates in the marketplace. Okay, I think we have to go to the break. So we're going to go to the break, and when we come back, we'll continue talking with Craig Miller with Norrep Mutual Funds, and maybe we can learn a little bit more. Don't go away.
Fred Snyder.
Statistically, if you take 100 people who start out equal today at the age of 25, by the time they end up at 65, 1 is wealthy, 4 are well-to-do, 5 are still working, 36 are dead, and the rest are dead broke, dependent on family and state. That's over half the people who start out equal at age 25, by the time they end up at 65, are dependent on family and state. And that's a sad state of statistics.
Fred Snyder.
You need a blueprint that says, this is where you're at right now, and this is where you want to go, and this is the way to get there.
Fred Snyder.
So isn't it time to get that good, warm, fuzzy feeling because you know exactly where you're at? You know that your investments are going to work for you. You know that you have the right investments inside your financial plan. You're confident about the future. because you've covered all the bases. You know exactly how much life insurance you need, and you have the right amount of insurance. You have a financial advisor, such as myself, or somebody that's equally competent that you can check with to determine whether you're on track or not. And whether you're on track or not, you know, I'd like to use the analogy, do you have a GPS?
Fred's got your GPS. Talk to Fred. Listen to Fred. Fred Snyder. Sunday mornings 9 to 11 on CIL 650. This is CISL Vancouver. Smooth and easy.
CIL 650.
This is It's Your Money on CIL 650. Here once again is Fred Snyder.
Okay, ladies and gentlemen, listeners out there, we are back. And again, we're talking about your money, more importantly, about your money and how to keep it. And the only way you're going to keep it, ladies and gentlemen, is to get yourself a written financial plan. To get a written financial plan, all you have to do is give Frida a call. She's down at the office right now. You can reach her at 604-737-3512. Forgot the number there for a minute. 604-737-3512. Give her a call and book an appointment. Come on in and see me. We'll talk about a written financial plan. No cost or obligation. In the meantime, in a second or two, we'll get back with Craig, but let's take a phone call. Let's talk to Victoria from Langley. Victoria, welcome to the program.
Good morning, Frederick. How are you doing?
I'm hanging in there.
A lot of good information about this gentleman being on here, Greg.
Mm-hmm.
But how much does the average person understand of that, not alone would maybe invest in that?
That's the problem. It's always the problem. It's understanding the fundamentals of investing.
Mm-hmm.
And people aren't strongly motivated to learn that. It's hard to learn, and they're not strongly motivated to do so. So you got to find an investment advisor that you can trust, generally speaking.
Mm-hmm. So, in other words, you know, it's very scary to put yourself in a high yield because things happen and then you lose money. It's scary.
Well, we know what the track record is, and the track record has been solid. So, I mean, if you got something that has performed very well over the last 5 or 6 years or even longer, then why is it suddenly going to change?
Mm-hmm.
I mean, there's risks in everything. If you know, Victoria, if you took $100,000 and put it in some kind of a vault or sealed it in something or another and buried it in the backyard and dug it up 10 years from now, it could very likely only purchase half as much as it could today. That's risk.
Yeah.
Even though nobody stole it, it wasn't earning any interest when it was buried in the ground, but inflation ate it all up.
Well, not only that, how many people have $100,000 not alone buried in the backyard or anywhere else?
Well, not too many.
But anyway, it's been very interesting, and I like the way he's done his name of the company and stuff like that. It's a lot like Oprah. You spell it backwards, it's Harpo. Anyway, have a great day. Bye.
Okay, you too. Take care.
Yeah.
Okay, Victoria's line is now open. So, ladies and gentlemen, if you just joined us, this is your opportunity to talk to one of the top investment people in Canada. You're talking to a fellow that makes the investment decisions at a very, very high level. It's like talking to somebody that manages the Canada Pension Plan, or any pension plan for that matter, or maybe the top investment advisor that works for Mackenzie Funds or Investors Funds. It doesn't matter who it is. This is your chance. Get on the line and give us a call. Let's discuss this, because we want to have conversations with you, our listening audience, about your money and how to keep it. Maybe you have some good ideas that you want to share with our listening audience, something that you have done that enabled you to become financially independent sooner. Maybe you can tell us how to keep your money. Maybe you're already financially independent, but you might want to say, well, this is how I've discovered how to make my money grow, how to draw an income from my money, and how to pay less tax. And this is what I do. Maybe you want to share that with us. Get on the line and give us a call. So Craig, back to you. We're talking about this issue of bonds, and this era that we're in right now reminds me so much of 1990.
In what way?
Well, with the difficulty getting yields on bonds, fixed income.
Oh, I see. Yes.
You know, back in 1990, I was kind of faced with the same problem, because I'm saying, okay, I got to get a defensive side to my investment portfolio, and bonds are really hard to find. So I decided to use asset allocation funds. I said, I'm going to leave that up to the money manager. Let the money manager figure out how much should be in fixed income. What do you think about that strategy?
Well, and that's exactly what we've seen at our company as well. We have two balanced funds, one of which I manage called Global Income Growth. And in that portfolio, we have the ability to change the asset mix between fixed income and between equity.
You can have it 100% in equities or 100% fixed income or some combination of both. Is that correct?
Well, not quite to that extreme. So we need to have in Global Income Growth, which is our global equity balance fund, we have the ability to go a minimum 10% fixed income and a maximum 40% fixed income.
Okay.
So right now we're at the lower end of that range. We're around maybe 14, 15% fixed income, just because over the last, that fund will have a 5-year track record as of the end of next month. Just over the last 5 years, or just about 5 years we've been running that fund, to us, in the global equity landscape, the better opportunities in terms of total return prospects have been in the equity part of the marketplace rather than the fixed income part of the marketplace. Now, the markets have done extremely well since the financial crisis, and so things are changing slowly but surely. So I would suggest to you that over the near term, we will start to increase our allocation to fixed income in our global equity balance fund. We have the ability to go to 40. We won't go to 40, but we have the ability to increase that allocation, and we likely will, just to reflect the better values that are available in the high-yield bond marketplace today, because of a lot of the sell-off that we've seen in a lot of those bonds over the last 6 or 7 months or so.
Okay, as an investment advisor, what is your general outlook for the markets? How much time do we have before the next major correction? And I know you don't know that one exactly. Nobody does. Yeah. But what's your opinion on that?
So, typically when you look at the marketplace post the financial crisis, if you call it, say, in global markets, the downturn kind of ended in March of 2009. So we've had, a good 7 years of, by and large, reasonably strong performance from most stock markets around the world. We've had the odd hiccup, a quarter here, a quarter there, a week here or there. But for the most part, it's been very good. But what I would say is an adage that markets bull markets don't end as a result of old age. So there's nothing, there's no, in our opinion, there's nothing that says, well, the market's been strong for 7 years and markets only ever last for 7 years and then they collapse or then they have a big correction. It's not like that at all. Typically, strong markets end when inflation shoots up, when interest rates go sky high, when valuations of stocks go sky high, when sentiment is euphoric. Every neighbor is talking to their other neighbor about all the money they made in the stock market last month or last quarter or last year, and they're sharing stock tips over the fence. I bought this stock, I'm up 100%. I bought that stock, I'm up 80%. That's when you need to be careful, and those are the conversations that people had in the late 90s, right?
Yeah, for sure.
Now it's really the opposite. The tone of the marketplace, I would call it constructive, but it's definitely not extremely bullish. So in terms of our outlook, if you look at the global marketplace, which is my area of expertise, I would say I still prefer developed markets over emerging markets for some of the reasons that we talked about when we talked about emerging markets debt. I don't think you're going to lose your shirt in emerging markets or anything like that, but I prefer, at this time, developed markets over emerging, although I would say I'm warming to emerging markets as valuations there have gotten better and the macroeconomic backdrop has gotten a little better as well.
Well, where are we right now in the economic cycle, in your opinion?
Well, it's definitely, mid to late cycle in a lot of the sectors of the marketplace, but that doesn't mean it ends tomorrow. That mid to late cycle part of the marketplace can last a long time, and we don't know when the next recession will happen. I can tell you in late January, a lot of people were worried that there might be a recession at the end of this year.
Yeah.
But now we've seen from the stock market that the stock market has rebounded quite strongly, and that fear is really back on the back burner today. At the end of January, it was on the front burner for sure.
Are we really out of 08 yet?
Well, in a lot of parts of the marketplace, we definitely are. And in some parts of the market, we still aren't, and in some geographies, we still aren't. So let me give you an example. If you look at the U.S. economy, if you look at profitability by U.S. companies as a whole, their profits are today over 20% higher today than they were in 2007. Okay, so the U.S. companies have recovered from the crisis and then grown a lot since then in terms of profitability. But if you go over to Europe, European company earnings are still close to 20% below where they were in 2007 today.
So globally, as the whole world really hasn't recovered.
Well, that's right. You have
certain sectors have, yeah.
And certain spots they haven't. So you can look at that in a number of ways. You can say to yourself, well, the U.S. is really attractive because not only did they overcome the crisis, they figured out a way to grow a lot from there. So that's great, and we like the U.S. market. It's one of our favorite markets. But when you look at a place like Europe, me as a value investor and a growth at a reasonable price investor, I look at Europe and I say, well, hey, I get the chance to invest in all these European companies that are valued more cheaply than U.S. companies today, and I'm going to be able to get profit growth out of these businesses just by waiting for them to catch up to where they were in 2007, and never mind trying to figure out how they're going to grow, from 2007 peak levels. So that's the real attractiveness of a place like Europe, because you have quantitative easing in Europe, which is helping the economy, but more importantly, in our view, you have this pent-up earnings growth or this pent-up profit growth that can help fuel the share price returns over the next few years. And we saw it last year. I mean, last year, the S&P 500 was, roughly flat for the year. You didn't really get much of a return investing in the U.S. in U.S. dollars last year, and Europe was up around 10%. Even though the U.S. economy last year performed a lot better than the European economy. So you have to be willing to not just look at the economies, but look at the profitability of these individual companies that are operating there.
What about government debt?
So government debt, I think long term, I really, really struggle to find any value there. Or do you mean U.S. debt?
For example, the U.S. federal debt is sitting somewhere, just current, sitting somewhere around $19 trillion, with unfunded liabilities over 50. I mean, what is the future there? Okay, so I get this question a lot. I don't have the numbers with me off the top of my head, but I will tell you, I read this great report written by an economist at National Bank a few years ago, and it really changed my perspective when talking about this issue. Okay, so I'll give you some general numbers. They're roughly correct. I don't have the to the decimal point. The that's
numbers
okay.
that
Sure.
we need.
No.
Roughly correct. Okay.
Yeah.
So this was a chart that this analyst, this economist, had prepared, and he had, I think, around 20 developed market economies on this chart. So Canada, U.S., France, Germany, U.K., you name it, right? But roughly 20. Now, what the chart had was it had a tax revenue as a percent of GDP or gross domestic product. Okay? So when you look at places like Canada, we were around, 30%, 31% of our gross domestic product, what our economy produces, is basically paid in taxes. So if our economy produced $100 worth of goods and services in a year, our country collects around $31 in taxes. Okay? Italy, France, etc., those countries were at like $40 on 100.
Okay.
The United States was about $25.
Okay.
So guess what, Fred? All you have to do, and like I say, I get this question a lot. You're definitely not the only one asking this question. I get it all the time. All the United States has to do to make these so-called unfunded liabilities disappear overnight is raise taxes by an amount that would get you to, I'll make up the number. I don't know exactly what it is. Maybe $27 or $28.
Well, 30 to 40 even.
Up from 20. When their competitors, our economy, France, Germany, Italy, UK, are way higher than that even today. So all of a sudden, if the U.S. it can raise taxes to get a little higher into the late 20s, all of those government debt, the issues disappear overnight. So I think that is the real way to look at the current situation with U.S. debt. Now, that's easier said than done. You need a lot of political cooperation to get taxes, hiked and all that stuff. So that's definitely easier said than done. But at the end of the day, if the U.S. government's back is against the wall and they have these unfunded liabilities, what are they going to do? They're going to do the only thing that they can do and the only thing that any rational person would do, and that would be to raise taxes on the U.S. economy overall to fix the situation, and away you go. The problem is solved.
Well, when Obama first came to power, the debt in the United States was $7 trillion, and that was 8 years ago. Now it's $19 trillion.
Yeah.
The growth in that debt is what the size. Yeah, that scares me, but the growth really scares me.
It is scary, and we've seen in the past, even in our own country, you mentioned 1990 earlier, when we had our own, sort of a mini financial crisis here in Canada, and our dollar got very, very cheap, and we had to take some tough medicine and cut expenditures and all of these things to fix the situation. So we've seen that happen before. I'm a little worried it's happening again, and some, both nationally here in Canada and at some provincial levels. But at the end of the day, you have to also look back and say, listen, we had a global financial crisis that the world had to confront, and I really and truly believe that we avoided, a depression in the developed markets by spending the way that we spent, that governments by government spending money the way that they spent it. If they hadn't done that, we wouldn't be talking today about, what about slow growth, and stock returns have just been okay, and unemployment rate is kind of stubbornly high in Canada. We would be having a much more difficult conversation about unemployment rates way higher than what they are right now, stock markets way lower, et cetera. So you have to be a little careful there in talking about the growth of debt since 2008, because we really did avoid a global depression, I think, by doing some of the things that a lot of major economies did.
Maybe so. The Trudeau basically projected running a deficit of about $10 billion. Upon being elected, increased it to 30. Three times that number. That's
absolutely.
That's $30 billion added on to about $630 billion in our debt right now. That's huge.
It is huge. Yeah, it is huge. So we'll see how how all transpires. But we'll see. I'm not sure that if you look at what a lot of major economists in Canada said, though, about the current situation, a lot of them actually did suggest that there needed to be a better sort of a fiscal or government response to the lackluster growth in the economy like Canada's. But is that what Canadians elected the government to do, to have a $30 billion deficit instead of 10?
Well, he's going to spend that on infrastructure, which he almost has no choice. Infrastructure has to be rebuilt, really.
Yeah.
Bridges are falling apart. Or roads are falling apart, and so on. So I don't think there's any choice. That's got to be done both in Canada and the United States, and maybe even the whole world.
That's right.
So tell me something. Does your firm have a infrastructure fund?
We do not have an infrastructure fund, and I would, in a lot of cases, put infrastructure in the same sort of a bucket or scenario that I would when we talked about commercial real estate earlier. That there's all of these very large pension funds around the world that are struggling to get a return on their money, because historically they've gotten a lot of their return from government bonds, and as we've said a few times, that there's not much return in government bonds today. So they've had to turn to alternatives. That one of the alternatives has been real estate, and another alternative has been infrastructure. So while infrastructure is an attractive asset class, the returns that you get in that asset class today are not nearly what they were, kind of 10 years ago. So attractive asset class. I wouldn't fault anyone from owning an investment in that asset class, a fund or what have you. But we do not have an on offering in that area at this time.
Okay, I want to talk. We're coming up to the break in a few minutes, but I want to talk about some of your individual funds. I have them loaded up here. Your number 2 fund over the last 5 years is No Rep Entrepreneurs Class Fund.
Yep.
That's a Canadian small mid-cap fund.
Yeah.
It's got a 4-star rating by Morningstar. What's your comments on that fund?
Well, this is a very, very interesting fund. The background is that is a fund that invests in very small, publicly traded, but very small businesses in Canada.
What's that mean? What's a small business in Canada?
So the market value of that business might be, say, $200 million or less. So it might be companies anywhere from, call it, give or take $50 million in market value or market cap.
But they're definitely not startup companies. They're established companies, but they're still small.
Yes, I mean, some of these businesses have been around for decades. It's just that they might focus on a real small market niche. It might be a very tiny segment of, the construction industry. Maybe they make products that go into, building an office building.
Maybe they make bridges and roads.
Well,
I'm
it's
kidding.
more likely in the case of this fund, maybe they make the nuts and bolts that you would use to make a bridge, rather than make the major pieces of the bridge, if you will, to try to keep it simple and straightforward. But the track record of that fund has been outstanding, and the reason we started it was we kept finding all of these attractive little businesses that were basically too small to fit into our large funds. If we bought up a position in those stocks, it was so small as a percent of the overall fund. Even if it were a double or a triple, it wouldn't really move the overall fund much. So we started this Entrepreneurs Fund to focus on these small, very inefficiently priced businesses. And our promise to our unit holders is to keep that fund very small, so that all these little businesses, when they do well, they have a big impact on the fund. So our Entrepreneurs Fund will never be $1 billion or $2 billion or $5 billion fund. We'll never, ever let it get that high.
But it's outperforming its benchmarks by a country mile.
Oh, absolutely. Absolutely. And there's a few keys to that. We're investing in the very inefficient part of the marketplace. A lot of times our fund manager, Don Walker, who runs that fund, will call the management teams and they'll say, you're the only investor to call me in months. And so you'll have a good conversation with the management, find out what's going on with the business. Mm-hmm. A lot of times there's no research available on these companies. You have to do your own homework. You have to model it out yourself. You have to forecast what the profit growth might be yourself. You have to talk to the management to find out more about the business, read the financial statements, etc. You can't just pick up a brokerage a research report and get a quick snapshot of the business. You got to do all the legwork yourself, and that's time consuming, and there's a lot of effort in there. But the result, I think, has been you're fishing in a pond that's full of inefficiently priced fish, and you get them on the hook, and sometimes it can work out very well for you. And Don's done a great job with that fund, and you mentioned the performance yourself that we've seen in that over the last few years.
You got 88% of the money in the fund is invested in Canadian equity, so that would make a really good Canadian equity fund. And the performance of that fund, $10,000 invested over the last 5 years, is almost $17,000 today.
Yes.
So those are pretty good numbers. The only number I have a problem with is it's got a high MER.
It does.
Again, if I was illustrating this fund to a client or offering this fund to a client, the client might say to me, "Yeah, but the MER is 4.31%." But the
true.
numbers I just gave out are after MER. I need to stress that.
Yeah.
In other words, that 4.31% is not deducted from the numbers I just gave out. The numbers I just gave out are net of MER.
Now, I think the Entrepreneurs Fund is a good example with some of our funds that have an incentive fee or performance fee of why the structure of that fund is the way it is. If you have a mutual fund in the marketplace today, then with the total assets in that fund are maybe $10 or $15 million, it's not profitable to have that fund around. If you have a mutual fund that has $2 billion or $3 billion in assets under management, that fund is very profitable because it has a big asset base and the fees more than pay for the expenses and the time and effort and researching the companies and so on. So the way you get around that by committing to our unit holders to keep our fund sizes very small. The only way to make them profitable is to have an incentive fee, and if the fund performs extremely well, then we get a performance fee from that, which basically pays the bills for the fund. And if the fund does not perform well, then we do not get that performance fee, and the manager and the company goes hungry in that case. So you're really incenting the manager to do. So
you're saying
well.
You're saying the 4.31 includes a performance fee?
It does. So if we don't perform well,
that's good.
In line with the market, then the fee will be way lower than that. But it's a bit like, again, when you do your income taxes, if you want them to be really low, then just don't make any money, and you won't have much of income tax to pay.
Well
if
said.
you want them to be really high, you make a lot of money, and then your taxes will go up. It's kind of the same thing. Yeah.
Well, that fund looks like a pretty good. Like, if I was doing it, if I said to myself, I need to build a portfolio, and I want to find a really good Canadian equity fund, this might be one of those funds that I would pick.
It would, but I would also say, Fred, that typical investor, you'd probably want that fund to be maybe 5 or 10% of the portfolio, and that's it.
Of course.
Yeah, because
in fact, if I'm building the equity portion of a portfolio right now, I would have 10% maybe in Canada, with maybe 25% in the United States.
Yeah.
Okay. I don't bet the farm on any one thing, no matter how good it appears to be at the time.
Yeah. Now, if you talk to Don Walker, the manager of that fund, He's got a lot of his own money invested in that fund, but that's his day-to-day job. He follows those companies all day long. He talks to the management teams. He knows exactly what's in there, and he's comfortable with the risks. But if you are a unit holder and you're looking at the net asset value of that fund in the paper or on the internet every few days or so or what have you, and you see it going down, sometimes it can be a little concerning. You're not sure what's in there. You're not sure what's happening. So a fund like that, and you sounds like you agree as well. You only want that to be a portion of the portfolio.
Well, there was a time that I would overweight a portfolio more in favor of Canada than the United States. I wouldn't these days.
Well, and that's, things have really, really changed on that front as well. Some numbers there for you. Back in the year 2000, Canadians had 32% of their long-term assets invested outside of Canada. Yeah. And then as of about 3 years ago, we had 8% of our long-term assets invested outside of Canada. And that's because, we had a great commodity cycle, and then in the crisis, the Canadian banks performed very well. A lot of things were going well for Canada at that time. And now, because of, largely weak commodity prices, the Canadian economy has struggled over the last few years. But a lot of other parts of the world, like the United States or, Western Europe, a lot of those companies consume commodities. They don't produce them, right? They buy them and then turn them into something else and then sell them.
Craig?
So they thrive when commodity prices are weak, and that's one of the reasons why those economies have performed better than ours and why people are moving their money outside of Canada.
Hold that thought for when we come back, because I have to go to the break. We're going to take a break right now, and when we come back, we'll continue talking with Craig Miller about NORREP mutual funds. Don't go away. So you got to start thinking about how you're spending your money.
Fred Snyder.
If you can reduce the amount of tax you pay, that means that you get a tax refund. So you get a tax refund means you've really overpaid your taxes. And if you overpay your taxes, what you've really done is loan money to the government. So rule number one of my 46 ways to ease the tax bite is don't lend your money to the government.
Fred Snyder.
So pay your taxes. We're not talking about not paying your taxes. We're talking about legal ways to reduce the taxes you pay, not avoid them, to reduce the taxes you pay so that you can have more money to save and invest so that you can achieve your financial goals sooner. And if you're already there, stay there longer, because once you get there, it's your obligation to stay there.
Fred Snyder.
If you have a financial plan and you're somewhere in the middle and you're wondering what tweaks that you should make in that plan to make it what you really want it to be, time to make a phone call. Or if maybe you're just getting started out and you want to get a starter plan, maybe it's time to talk to somebody like myself and get yourself on the right track.
Fred Snyder.
I think that everybody needs to go and make an appointment to see Fred.
Talk to Fred. Listen to Fred. Fred Snyder. Sunday mornings 9 to 11 on CIL 650. Welcome back to It's Your Money on CIL 650. If you have a question for Fred, call 604-280-0650. Now, back to Fred.
Okay, ladies and gentlemen, listeners out there, we are back. And again, we're talking about your money, more importantly about your money and how to keep it. And we have a great guest here today. It's Craig Miller. He's an investment analyst. He's the head honcho for NORREP mutual funds, and that's a big family of funds. And they have a very, very exciting lineup of investment funds that they offer the public. And I've been talking to him about why NORREP funds stand out, how they differentiate from other mutual funds that are offered out there, and so on. And maybe it's a good idea to have some of these funds in your overall portfolio. We just finished discussing their Canadian equity fund. It looks pretty good. So any further comments on the Canadian equity fund, Greg?
Yeah, so NORREP entrepreneurs, as I say, that I think in general that's a great option if for a small portion of someone's portfolio who's looking for a way to increase their returns over the medium term. We think the prospects there remain great. Don Walker, the manager, is a terrific stock picker. He's had a lot of great investments in that portfolio. And it's something that's extremely different. There's over 10,000 mutual funds in Canada, and there's about 2 or 3 in Canada that invest in those small, very, very, very small businesses like the ones that our NORREP entrepreneurs invest in. So, again, it's a great example of how we try to differentiate ourselves. We try to do things that are different than most of the other big fund companies out there.
Okay, I'm not going to review all the funds. I'm just going down my list here. The third top performing fund is NORREP Global Class, I'm going to skip that one. The next one on the list is NOREP Income Growth. That's a class fund as well. So we're using the term class. Now, my understanding is, like, first off, a class fund, you can switch within your various funds without triggering taxes on class funds, correct?
Well, it's true today.
I
but it
know.
won't be true in
I know
September.
Trudeau killed it.
Yeah, it won't be true in September.
Yeah.
Because the rules have changed.
Okay.
But nevertheless, there are still other advantages to a corporate class structure today. So it won't, that ruling, I don't think will have that big of an impact. I mean, we see at our company, of course, we see all the transactions that everybody does in the funds each day.
Yeah.
And there's really not that much that in terms of switching between funds.
Let's not spend a lot of time there. Let's just go for this NOREP income fund. I'm curious. I'm anxious to take a look at it and see what its numbers look like. So I'm opening it up right now on my computer. It's ranked as a 4-star fund. It's kicking the heck out of its indexes. It's outperforming the index by a wide margin. If I go to the 5-year span on that particular fund rather than 10 years, it's struggling a bit right now. It's had a pretty sharp drop there. The MER is only 2.08 on that particular fund. It's a balanced fund. Let's just talk about it. You got any comments?
Sure, of course. So that has been a very, very strong performer for us. It's got over a 10-year track record. It's a multiple award winner. It's won a Lipper Award at least twice. And that I mentioned earlier that we have 2 balanced funds. I manage one of them, Global Income Growth, and this is the Canadian one, just called NOREP Income Growth. So again, it's a great example of how we're different than everybody else, because in that Canadian equity balanced category, with the funds that compete with our income growth, most of those funds own the largest of the large stocks in Canada. So the big banks, the BCE, all of those big names are the majority of the assets. And that's great, and those have been good investments and all of that, but we try to be different. So we would own the odd one of those. We'll own the odd bank. The odd time we'll own BCE or what have you. But the bulk of that portfolio is invested in small and mid-sized businesses in Canada that pay a meaningful dividend yield. So that fund pays a monthly distribution, which is very attractive.
Hence the word income in the name itself, income and growth.
That's right. And it also has an allocation to fixed income. Off the top of my head, I don't remember exactly what it is. I want to say high teens in terms of percentage exposure to fixed income. But so that is able to dampen the volatility of that portfolio a little bit over time as well, and helps generate a lot of income that we can, of course, distribute to the unit holders. So it's a great combination of small and mid and some large, meaningful dividend yield paying stocks, along with some fixed income securities that pay a meaningful yield as well. And as I say, the track record, the fund has been around for over 10 years. It's one of our largest funds, and Alex Sasso, who's also the CEO of our company, is the lead manager on that fund. And as I say, they've done a great job. It's been a good seller for us, and the unit holders are very happy with that.
Peter Drucker, the Dean of Modern Business Management, has often said that if you can't measure it, you can't manage it. So when we talk about investments, we need to manage our investments, so we need to be able to measure them. There's ways to measure funds. And at the risk of getting into complicated areas, I'd like to talk a bit with you about that. We have terms that we use, like beta, as an example. Could you explain beta to our listeners?
So,
what does beta mean?
Sure. Beta is, right now, everybody, a lot of investors we talk to, they want low beta. So what beta means is, let's say you have $100 invested in the TSX, the TSX 60 index.
So the benchmark is the TSX index.
Yeah. So let's say you have $100 invested in the TSX, and then you have $100 invested in a given stock or a given fund. So if in 1 year, let's say, the stock market, the TSX goes up 10%, and the fund, say in this case income growth, goes up 15%. That would mean income growth would have a beta of 1.5.
Higher than the 1, because 1 is the market itself, right?
Right, that's right. So you're going to get 10% out of the market, but you'd get 15% out of that fund or that stock or what
So
have
it
you.
performs better than the fund. Or,
Right.
excuse me, better than the market.
Better than the market. Now, again, it works both ways. So if the TSX goes, the true definition of beta, if the TSX goes down 10% in a given year, a typical, if a fund or a stock or what have you has a beta of 1.5, that means that fund or stock is likely going to go down 15% in that year as well. So it'll go down more than the market, but it'll also go up more than the market in up times, which most times people, if a stock or a fund has a beta of above 1, think about it. The stock markets go up most of the time. So if stock markets go up most of the time, surely you would want to have most of your portfolio invested in things that have a beta slightly above 1, because then you're going to do better than the market most of the time, which goes up most of the time, right?
Well, an index fund generally would have a beta of 1.
That's right, because if the market goes up 10, the index fund will go up 10. If the market goes down 10, the index fund will go down 10. So the beta will be exactly the same as the benchmark, absolutely. Now,
so are you better to have a high beta or a low beta? What's the answer to that question?
That's a difficult question to answer, because if you are 30 years old and you have a very high risk tolerance and you're not going to retire until you're 65 and maybe you have a life expectancy till 80 or 90 years old, chances are you probably want a portfolio that's a little bit higher beta, because you've got lots of time on your hands. Any downturns, great recessions, normal recessions, stock market corrections, you're going to be able to ride all of that out, and because you got all this time on your hands. If you're 80 years old, you maybe your time horizon is obviously not anywhere near as long as it is if you're 30. So if you're 80 years old, you probably want a beta way below 1, because in that case, if you get a market correction, you might not see the other side of it if it were a big correction and a multi-year recovery type of a period.
So whether you should pick a high beta or a low beta would depend on your timeline.
That is to boil it down and keep it as simple as possible. That is basically true. Now, there's other factors at work here, though, too. So right now we're in an environment with low government bond yields. So what's happened is a lot of people have decided to sell government bonds and buy low beta stocks as well. And by low beta, I mean, food manufacturers, beverage makers, all these types of businesses where the supply demand doesn't change too much in any given year. It's like groceries, shopping for groceries. If the economy's weak, it's not like you say to yourself, okay, well, I just won't go to the grocery store this month. I mean, you have to go. You got to buy fresh food and put it on the table in your household. But if if someone doesn't want to own a government bond because the yield is so low, chances are they're not going to go and buy a steel stock, a company of a stock of a steel maker, which in any given year that stock can either be up 100% or down, 50 or 60%, because it's just too wild a ride. So what they'll say, well, I'll go and I'll buy shares in General Mills or a BCE or something that is much lower in terms of volatility, both the stock performance and the business performance, because I'll be able to get a bit of a dividend yield, and I won't have to lay awake at night worrying about whether the stock's going to be up very substantially or down substantially the next day. So people now prefer low beta because we have so many investors that have gone from the government bond market where there's no yield into other parts of the market trying to get better yield.
And every mutual fund that's out there has a beta rating.
They would, and if it doesn't, you can simply, various types of software, you can calculate it yourself. Yeah.
Well, I can go into my database that I have in front of me right now on my computer screen, go to the beta column, and search it in descending order with the biggest beta at the top and the lowest at the bottom, or vice versa.
Yeah.
So that way, if that becomes a part of my selection criteria, that's what I would do.
Yeah.
So with the software that's out there, it's quite possible to be able to get a great deal of information. Like I'm looking here, for example, looking at your list, you have an energy fund.
Yes.
I haven't opened that up, so I haven't looked at it, but I dare say the numbers would be a struggle on that fund right now, would it not?
Well, because of
because of what's happened with oil
price,
of course. Yeah. Let me let me take a look at it. So it's coming up here on my screen in a second. So let's see what it's done. Well, it's got a colossal drop in it.
Yeah.
Which comes as no surprise.
Yes.
If I take it on 5 years, it's actually outperforming the benchmarks by a little bit.
Yep.
But the decline at the top was just getting into 2013, and if that was 15,000, it's down to 9,000 right now.
Yeah, yeah. So there's been, for investors and for employees and everybody else, there's been a lot of pain felt in the energy industry over the last year and a half or so, obviously because of the collapse in energy prices.
So what I try to do is select investments for my clients who don't have large exposure to energy right now. And using Morningstar Workstation, I can do that. I can I can put a column in there for exposure to energy and sort by that column and be able to select funds that don't have a lot of oil or energy in there.
That's right. And then if you change your mind a few months from now, say the market gets better or the oil price forecasts look a little rosier, you're going to do extremely well in those stocks, and then you might want to do the opposite, right? You might want to search and say, okay,
well, that's what
funds
all
out there have more energy exposure.
Right on. Okay, so what does alpha mean?
Okay, so alpha is basically a measure of outperformance or the lack of outperformance. So, in other words, if the market does a 10% return in a given year, and a fund does a 12% return in a given year after all expenses or what have you, that's generally considered to be 2% of alpha generated in that year. So you had 2% performance better than the marketplace. You did 12, the market did 10. So the holy grail, by the way, in investing in anything really, whether it's stocks or funds or whatever, what have you, everybody wants very low beta, and they want very high alpha. So they want the fund or a stock to not move much differently than what the market does, or ideally much less than the market does on the downside, and then they want it to be up more than the market on the upside. And unfortunately, that is a very, very difficult combination to achieve.
Oh, for sure.
Nevertheless, that's what people want. That's the age-old demand. I want to not have as much volatility as the market, and I want to perform way better than the market, which is tough to do.
It's like picking a series of securities. Let's say you pick 5 individual securities that have some really good numbers, and to mitigate risk, you want to find investments which are perfectly negatively correlated to the 5 that you just picked. That in a perfect world, that would be perfect, but that's almost impossible.
Yeah.
Okay. In other words, if one is up 10% at the same time one is down 10%, that's perfectly negatively correlated.
Yeah. And as you get older, your time horizon changes, your risk tolerance changes, and all of that, all those things. But I remember in the global financial crisis, a comment by Warren Buffett, obviously one of the richest people in the world. He said that Berkshire Hathaway had gone down by 50% 3 times since he started that company, that investment company. So I think you can, if you've got a reasonably long time horizon, you can do yourself a real disservice by trying to be extremely conservative, but relative to the time horizon, the amount of time that you have to invest your money. Now, ultimately, someone has to feel comfortable, and Fred, you know this better than I do. If someone that can't sleep at night, if they just do not have a tolerance for downturns or what have you, then that's not appropriate because it's just ultimately not physically healthy for that investor. But if you have a reasonable time horizon, it's best to make a diversified portfolio out of a good collection of securities or funds or indexes or what have you to give you a good total rate of return over the medium term. But trying to it's a bit like in a hockey analogy, you're never going to win the Stanley Cup if you have 5 defensemen on the ice at all times. I mean, you won't get scored on.
Perfect
but you'll
analogy.
never win the Stanley Cup, and you'll be last in the league every year because you'll have 5 people on the ice that typically score 2 or 3 goals a year, and it's just not going to work all that well.
Yeah, very, very good point. So anyway, let's talk about standard deviation. Standard deviation is a way to measure risk.
Yes.
So a low standard deviation, what would be a typical low number for standard deviation?
Well, that's kind of a hard question to answer because it really depends on the asset class. So if a portfolio that invested in internet if you were comparing a bunch of funds that invested in internet stocks, a low standard deviation there might be 20%, and a high one might be 30%. But if you had a portfolio that invested in the Canadian banks, a low standard and similar types of securities, a low standard deviation might be 5, and a high one might be 8. So it really depends on the asset class in which you're looking at. That's the best way to compare it.
So I can take, but I can take your whole list of funds, and there's a column in there for standard deviation, and I can sort them by standard deviation.
Yep.
And at the top, I will have let's say I sort descending order, so the top one will have the greatest standard deviation, and the bottom one will have the lowest. What would that range be?
Well, I don't have that in one chart or one table off the top of my head, but typically, if I were to, the highest standard deviation would probably be our energy fund. I mean, I would imagine that's probably
More than likely.
Late teens or early 20s, something around there.
And standard deviation is always calculated based on past performance anyway.
Yeah, and it's just a measure of volatility over time, right? So a low standard deviation means the net asset value doesn't jump around very much. The price of the fund doesn't jump around very much in any given year. And a high standard deviation means the price of that fund jumps around a lot in any given year.
Volatility.
Remember, if you are volatility, but if you think the markets are going to do very well in a given year, I mean, if you want to make the most money, you're going to want to buy a fund that has the highest standard deviation because it'll go up the most in a great market. But if you think the market is going to go down a lot in a given year, then you'd want to select something, or at least you think there's a chance that the market's going to go down a lot in a year, then you're going to want something with low standard deviation so that you don't have as much downside.
Isn't standard deviation the square root of the mean?
Well, it is the simplest way to I think to explain it to an individual investor is, a standard deviation is typically 2/3 of the time if there's what is the return of that fund going to be in a given year based on past performance. So you're talking, if it's an 8% type of a standard deviation, 2/3 of the time the observations of the return of that fund are going to be about that. So to use that, the other extreme to the energy fund for us would be our short-term income fund, and that's got a standard deviation of around 2% or 3% for both our short-term and our high-yield fund. So that goes to show you, there's a lot less net asset value volatility with our fixed income funds, of course, than there is with our equity funds or specialty equity funds.
We talked earlier about your NORREP entrepreneur class. I'm just looking down my list, and number 17 on the list is NORREP Entrepreneurs Class I or 1, and it's got 5 stars. Are you familiar with that one?
I'm sorry, can you say that again?
It's NORREP Entrepreneurs Class 1, or Class I.
Oh,
it's that's 5-star fund.
That's just a different class of the same fund.
That's institutional.
Yes. I series stands for institutional, so if you're a large institutional investor, then...
So that's not available to everybody.
It isn't. So if you're going to if you're going to put $1 million into that fund, then you would be able to negotiate a lower fee level because of the level of assets that you're committing to the fund.
You have a NORREP Global Income Growth Fund. That's a class fund, Class A. It's also 5-star. And then you have an institutional version of the same thing.
Yes.
Let me open up that one. I want to take a look at that one.
Okay.
Simply because it's got 5 stars.
And I manage that one, so...
well, you like talking about that one, then.
I'm familiar with that one, yeah.
Okay, let's pick 5 years.
So it'll have a 5-year track record at the end of next month.
Yeah, it's got 5 years for sure. And excuse me, it doesn't actually. It says at the top that it does. It's got 3 years though. If you put $10,000 in 3 years ago, it's worth $14,000 right now.
Yes.
Which is pretty good actually. It's outperforming the benchmarks. The MER is 3.78. It's a 5-star fund.
Yes.
And it's available to the public at large.
Yeah. So we'll talk about that. So NORREP Global Income Growth. So I manage that fund. I've been a manager since inception. And as I say, I've been at this for a little over 19 years, so I've got a lot of experience investing outside of Canada. That's what I've done virtually my whole career. Though over the years, I've traveled to 35 countries in my life. I've been around the world many times. Most of the companies that we have in the portfolio, I've met with the management personally. They come to our office in Toronto, or I would go to their location, depending on the country that they're in, and around the world. And that fund is a great mix, we think, of small, mid, and large-size companies that pay.
It's a well-diversified fund.
Well-diversified and pay a meaningful dividend yield. So we pay, out of that net asset value, we pay a monthly distribution that works out to be about a 4% annualized yield. and that distribution is tax advantaged. So all of the distributions received, or the dividends received from that fund, are in the form of Canadian eligible dividends. Or
they qualify for the dividend tax credit.
Yep. So it's not regular income. So that has been our best-selling fund, outside of Canada over the last couple of years. As you say, it's rated 5 stars by Morningstar, and as I say, we have around 14% of that portfolio today invested in fixed income. So that helps mitigate the volatility a little bit, and B, it helps generate additional income for us to pay out to unit holders. But in that fund, we invest in, as I say, small, mid, large-sized companies. We invest in the U.S., in Europe, a little bit in Asia, some in Asia ex-Japan, some in Japan. And combined, as I say, we have a great group of businesses that have very good returns on equity and invested capital, generate nice distributions that we then pay out to our unit holders. And again, you asked me, what do we do differently? I mean, our fund is different than most of the other funds in this category because of our willingness to find the small, mid, and large companies that are different than the other than the other fund companies' offerings in this asset class. So, in the top 10 holdings, for instance, there's two positions. One's called Elm Brand, which is an insurance company in Denmark, a small one, and another company is called Hal Trust, which is almost like a Berkshire Hathaway in Holland. And in the case of Elm Brand, I think we're the only Canadian shareholder of that company today. There's nobody else in Canada owns shares in that business that we can find. And in Hal Trust, the same thing. We are the only Canadian shareholders in that business. So we go out of our way to try to find these businesses that are unique and different, and just give us a way to differentiate our offering relative to our competitors.
So, Craig, how does the process start? You're there, you're sitting in your office, and you say, okay, I need to find something to invest in. What questions come to mind?
Well, there's a few different ways that we would use to find new investments. Number one, it would be called a quantitative analysis. So that's just
now, what does that mean? Because that's fancy words.
Yeah, so that's just simply screening. So no different than your colander in your kitchen. You get a big pot of boiling water and pasta, and all you want to do is focus on the pasta and let all the water go away. So you pour a bunch of data into a colander, and the water goes away, or the stocks that aren't attractive to you would be the water. That all goes down the drain, and you're left with the pasta, and you spend all your time focusing on the pasta. So that's an easy way to kind of distill the world down to a meaningful size. So there might be 20,000 companies around the world that we could potentially invest in. So you want to have a really great set of colanders to try to whittle that down to maybe 100 or 200 companies, and you do that on a regular basis.
So what are some of the measurements that you use to select a company?
Yeah, that's a good question. So you would look for companies that maybe have a low PE ratio or low price-to-earnings ratio.
What does that mean?
So that's one of the most commonly one of the most common measures to assess the value of a business. So what's PE ratio? Well, if a stock has a PE of 10, if it's a $10 stock price and the company earns $1 in earnings per share, that would have a PE of 10. So $10 stock price divided by $1 in earnings.
Okay.
So that would be, in today's market, that would be considered pretty cheap, around 10 times earnings.
So earnings is gross earnings, which would include retained earnings as well as dividend distributions, correct?
Yeah, so earnings would just be, the net income of the business,
gotcha.
After taxes divided by the number of shares outstanding. So, and then to again, take that a step further, let's say you had a $30 stock and only $1 in earnings. Well, that would have a PE of 30.
That'd be pretty expensive.
That would be considered pretty expensive. And so your analysis is different. So if it has a PE of 10, you have to figure out, well, how might this company get a PE of 15? Because even if the earnings don't go up, if I can forecast or if I can try to figure out a way that the market might be willing to award that company a PE of 15 instead of 10, I'm going to make a lot of money because the stock's going to go from $10 to $15 and with all else unchanged. But with the 30 PE, you have to say to yourself, well, how much is the earnings, or how much is that dollar going to go up each year, and hopefully the 30 doesn't change. That's the way that I make money. So it's two different sets of analysis. But typically, we look for the cheaper valued companies in the marketplace because we think over the long term that's typically the better way to earn your return. Because
like Warren Buffett.
Kind of like Warren Buffett. I guess you could say that. I guess kind of like Warren Buffett.
You want to find something that's inexpensive, and a low PE would mean it's inexpensive, and a high PR or PE would mean it's expensive.
A high PE would mean it's expensive, right?
Yeah. We have to go to the break. We're going to go to the break, and when we come back, we'll continue talking about that, so don't go away.
Fred Snyder.
I want you to imagine a person who is uptight, always worried, has high blood pressure, looking at their bank statement every time they turn around, and it's always red, okay? They're spending more than they earn. They can't seem to get out of the hole. They're always telling people, I'm catching up, I'm trying to catch up, so they're always behind the 8 ball. And life isn't pretty, and they're not happy, and they're frustrated. And they're not even fun to be around, those kind of people. There's a black cloud hanging over their head. Visualize that, because there's lots of people out there right now that are in that boat.
Fred Snyder.
And you have to ask yourself the question right now, what would happen if that happened to me? Because here I am. I'm sitting out here. I don't have a written financial plan. I haven't taken the time to sit down and think about my goals, the things that I really want to accomplish. I'm like a ship without a rudder. I have no direction. I'm procrastinating because I don't know what to do. And I'm still not doing anything about it. So instead of being proactive as I should be, I'm being reactive. I'm waiting for the bad stuff to happen and not controlling my destiny. If that's you, it's time to make a phone call.
Call Fred. Talk to Fred. Listen to Fred. Fred Snyder. Sunday mornings 9 to 11 on CIL 650. This is CISL Vancouver. Smooth and easy.
CIL 650.
You're listening to It's Your Money on CIL 650. Once again, here is Fred Snyder.
Okay, we're back. And ladies and gentlemen, listeners out there, we're talking with Craig Miller, who's with NORREP Mutual Funds. And we're talking about the selection process. How do you pick stocks? And by the same token, how do you pick mutual funds? What is the selection criteria? Because ultimately, when you hire me to be your financial advisor, you are picking my ability to select investments on your behalf to be able to build a portfolio. And when I hire somebody like Craig Miller and I offer his funds to the public, it's the same thing. How does he select the securities that he puts into the portfolios that they offer the public? That's what it's all about. So we need to find ways to measure, and always at the risk of getting complicated when we get into these measurement processes, you have to understand that there is a way. We don't put the chart of stocks up on the wall and throw darts at it. That's not the selection process. There has to be a meaningful way to select securities. So when we went to the break, we were talking about whether a stock is overpriced or underpriced. Warren Buffett says, if I can buy it for less than it's worth, and I can wait long enough, I'll always make money. And secondly, I need to understand it or I won't buy it. That's his process. And value investing, that's how it works. So you find a security which is out of favor, which you can buy at a discount. It may be still a very good security, but it temporarily might be out of favor. And that becomes a bargain. So if you can buy it at a discount, that's the name of the game. And the PE ratio is one way to make that measurement. So any comments on that one, Craig?
Yeah, so the PE is one way to make that assessment. Is this company cheap or expensive? Another way is, and I'll explain it in simple terms, is what we call return on equity. So we love to find companies that have a relatively low PE and a relatively high return on equity, or ROE. Now, what does ROE mean? Well, let's assume a business has $100 in equity invested in it. Okay, so there's $100 in equity invested in this business. Now, if that business earns $1 in profit in a year, that's an ROE of 1%. Okay, that's a pretty lousy rate of return. You earn $1 on 100, because as we talked about earlier, you could do better buying a Canadian government 10-year bond and make 1.26% on your 100,
yep.
And you wouldn't have to get out of bed in the morning, right? Never mind manage a business and so on.
For sure.
Now, so what we look for is companies that have a high ROE. So in other words, again, if you find a business with $100 invested in equity in that business, and they can generate $15 or $20 out of that $100 in equity investment, that's an ROE of 15 or 20%. So that is way better than what most people can achieve themselves, and what, of course, you could get in a government bond or what have you, especially at this point in time.
If you can buy it at a discount, it's even better.
It's even better. And as you can imagine, Fred, over 5 or 10 years, if you buy a basket of securities, in other words, you put a bunch of investments in one of our funds that, as a group, generate an ROE or a return on equity of 15 or 20%. Think about that. I mean, in the first year, they make $15 or $20 on that 100. Then the next year, they make another $15 or $20 on that 100. I'm simplifying it here, but it compounds over time, and it makes your returns really good. Whereas if you invest in a bunch of businesses that have an ROE of 1, they're only making $1 on the 100 every year. The first year they're going to make $1 on your 100. The next year they make $1 on your 100. The next year, so as you can see, the poor returns compound poorly as well. So for our portfolios, we try to find, as I say, a group of businesses that have relatively low PEs and relatively high ROEs, because we think that combination is what will give you the best medium and long-term rates of return that you can get. And that is the way that we manage, our NORAP Global Income Growth Fund that I manage, that we manage entrepreneurs, that we manage our flagship NORAP fund that has the best track record in Canada over 15 years. Very, very similar. Very, very similar type of strategy. And then I also have a fund, a new one, that we've just launched a couple of months ago called NORAP Core Global. And that is actually a neat combination. It's a low-fee product, and for the F class, a capped MER of 1.2%. And it invests in what we talked about beta earlier. It invests in low beta securities, so high-quality, low beta, or low volatility securities. So it's managed a little differently than some of our traditional funds, but it's in very, very high-quality businesses with share prices that don't move around as much. So typically it's going to give you kind of a smoother rate of return, we think, and as I say, very, very high-quality businesses.
Generally speaking, my job is to manage clients' expectations. And many of my clients believe, rightly or wrongly, that somehow or another, as if by magic, I can predict what markets are going to do. So here you are an absolute market expert. I know from talking to you right now. So can you tell me what the markets are going to do?
I absolutely I can't. I cannot do that.
And you know something? I know lots of people coast to coast. I don't know a single soul anywhere that I can pick up the phone and phone them and say, tell me, what are the markets going to do? They'll all answer exactly the same way. Because you can't. It's impossible. And you have people think to me, well, why didn't you get me out of that before the market went down? The market goes down, it may continue to go down. If it goes down, it may come back up tomorrow. Just go back to last February. What happened last February in the markets?
As in 2 months ago?
Yeah.
Oh, I thought you meant in 2015.
No.
2 months ago.
Just 2 months ago.
Yeah, what happened in February, a couple months ago, we started the year, I think, when I say we, I mean investors at large, expecting very strong growth in a lot of the economies in the world, expecting strong stock markets. And then 3-4 weeks later, end of January, early February, people got very, very worried about growth, about profitability. People started saying, what if we have a recession in the second half of 2016? And
it was a bloodbath.
Yeah, stock prices went down significantly. And then what? We got 3 or 4 weeks later, all of a sudden, I don't think there's going to be a recession at the end of the year. Actually, profits aren't that bad as I thought they were going to be a month ago. Actually, a lot of the businesses that we follow are doing a lot better than we thought they would have been.
The Fed was going to increase interest rates?
Yeah, the Fed's not going to raise interest rates as fast as we thought. Hey, the U.S. unemployment rate continues to go down. It's a new low again. And so sentiment, of course, has a big impact on stock prices in the short term. But as I say, you have to do your best to try to think the long term. And do I own a high quality portfolio? Do I have a high quality group of assets in my portfolio? And if the answer is yes, then you're going to suffer some short term setbacks from time to time. But over the medium and long term, you're going to do very well.
What in your view right now, Craig, what would the ideal asset allocation be for somebody who is at or near retirement?
Fred, that's a really, really tough question for me to answer.
I know it is.
I know that's what.
That's why I ask it.
Yeah, that's what you do for a living. I try to find good global investments for my global funds that I manage that I think will serve investors well, over a 3, 5, 10-year time horizon. And I leave it to experts like Fred Snyder's of the world to determine how much of my fund should be in someone's portfolio, because you know your clientele. You sit down with them, you talk about their goals, you know how they've maybe handled past setbacks in the marketplace, when recessions arise or when stock market corrections occur or what have you. And so that's one of the ways when you have a good relationship with an advisor, they know you and they know you well, and they can help design a portfolio that suits your needs best. It's not a cookie-cutter solution. It's something unique to you as an individual. So for me, I can tell you, for me personally, I mean, I've got a long time horizon, so I have a small portion of my assets invested in fixed income, and the majority in equity, but I'm an equity investor. I do this all day long, every day.
Craig, how old are you?
I'm 44 years old, so
Okay.
I've seen a few cycles. I've seen, the big '08 crisis. I've seen the meltdown that happened in the technology markets after the late '90s. So, but I've also seen the euphoria of the '90s, the euphoria of the world leading up into 2007. So, you kind of learn not to get too carried away when things are good and not too pessimistic when things are bad. But for me personally, I typically like equity, and I typically have more than most people invested outside of Canada. But again, that's what I do for a living all day long. I know my businesses. I know their exposures. I know the ups and downs of what to expect. I can't time them, but I know what to expect over a given cycle.
But if you're looking long term, you don't have to. I don't think.
That's right.
Let me go back to the original question once again. Let me help you with the question. Let's say that I want to build a portfolio that's 50% fixed income and 50% equity. How would I build that portfolio then?
So I would say, maybe today you want to have, if it's half of it is in equity, maybe you have, half of that half invested outside of Canada, half of that half invested inside of Canada. So you got 25% allocated to Canada, 25% outside of Canada, and then within the fixed income portion of the portfolio, you probably, this is likely an older person asset mix. So maybe you want to have some cash. Maybe you have 5, maybe you have 10% cash in that portfolio, because if they have to draw money out of it and there's a downturn, maybe you don't want to sell stocks when they're down. And then, so if you just round numbers, let's say it's 10% cash, and then you've got 40 of the 50 left to go. I would have a mix of a little bit of government bonds, investment grade, and high yield in that portfolio as well. That would be my asset mix.
So you like the high yield? We talked about that earlier.
Yeah, I listened to a conference call late last week with 2 industry experts, both of which have over 40 years experience investing in the U.S. market. And they asked this one gentleman, he's over 80 years old, I believe now, still working, still all fired up. And they asked him, what are your 3 segments of the marketplace that you want to invest in over the next 10 years? And he said he would actually want to buy the riskiest part of the high-yield market today, especially energy, because he thinks on a 10-year view you're going to make a very attractive rate of return there. Now, is that my recommendation? No, but this is an expert with decades and decades of experience pointing out the attractive valued parts of the marketplace today, and he specifically pointed out high yield. So I thought that was pretty interesting.
But we said it earlier that nobody really knows. Nobody. I mean, we have to make educated judgment calls in terms of what we do, but nobody really knows. You can't predict what the markets are going to do, really.
You're right. And building a portfolio, again, let's use the hockey analogy.
Yeah.
If you're a general manager of an NHL hockey team, you want to have the best diversified portfolio of players. You want a good goalie, you want good defensemen to protect you when the puck's in your end and you're under stress, and you need good forwards and left winger, right winger, and centerman to help you when you want to be offensive, when you're in the other team's end and you want to try to score goals and create as many points as possible. But you can put the best NHL team together that you think you can within the current constraints of budgets and salary cap and all that, and you can do the best job you can, but you can't at the first game of the year, the NHL season, predict if your team's going to win the Stanley Cup or not. I think you can predict whether you're going to get close or not, but you can't predict whether you're going to win at all. And it's no different in managing money. In portfolios, I have a mix of defensemen, of centermen, of left wingers and right wingers. But if I put that whole team of players, if you will, a group of stocks together in the portfolio that I think will serve investors well when times are tough, serve investors well when times are good. But can I predict whether it's going to be a 7% rate of return or 12 or 5 or 15? I mean, you just can't. You can assemble a group of securities that will give you a good medium and long-term performance, but you can't predict what it's going to do in any given year.
So the best thing you have to go on is past performance, because there's nothing else, really.
That's right. And even assessing management teams for us for the stocks that we put in the portfolios. How long has the CEO been running the company? How much experience does the CEO have in this industry if he's new to the company? Has this company performed well in previous downturns? Do they have significant market share to help protect the business when times are tough?
So, Craig, when you hire somebody, you want to know what their track record is.
Yes.
And when a client hires me to look after their money, they want to know what my track record is. What securities do you pick inside your portfolio? How successful have you been in the past? How much money are your clients making? What is the expected rate of return? Are you aggressive in your approach to investing, or are you conservative? How many clients do you have? How much money do you look after? These are all the questions that are really pertinent in choosing a financial advisor, or you as a wholesaler offering product to financial advisors. So the key question is, because I want to do business with you, and if I want to do that, then how do you differentiate from other firms that are out there? What makes you different? So we're back to that question again, because that's the key. I can tell you what makes me different, but what makes your firm different than CI Mutual Funds, as an example?
Yeah. So, CI is a great mutual fund company, but I think what differentiates us is two.
They certainly have more funds than you do.
They definitely do. And remember, that's on purpose. That's not an accident. That's because we only want to offer products in areas that are very difficult for an individual investor or for an advisor to do themselves.
Well, that's a differentiation point right there.
Right there. The other one is, Fred, we have a commitment to our unit holders to keep our fund sizes small. That is very important. The reason that's important is if you have a mutual fund with $5 billion in assets, and that manager finds a wonderful small company that's maybe worth $500 million, and they want to invest a portion of their $5 billion fund in that business, I mean, they'd have to buy the whole company for that stock to have an impact on that large portfolio, because if they make a $10 million investment, they buy a small part of that company as a shares outstanding. Even if it's a double or a triple, the fund is so huge it won't make a difference. Whereas we have, like our Entrepreneurs Fund, a commitment to our unit holders to keep that fund small on purpose, because we want to be able to buy these small companies so that when they do extremely well, the unit holders feel it. So that's a second very important area of differentiation, that we have decided to, with most of our funds, to keep the fund sizes small. We've shut down our funds before. Our original Canadian small cap asset class, once in the past we got to $400 million in assets, we shut the funds down to new purchases. Some of the competing funds in that asset class are multiple billions in assets, but we have decided that you can't run more than around $400 million in Canadian small companies before it starts to impact performance negatively. So that's our promise to the unit holders to keep the fund sizes small. You'll never wake up one day and see the original NORP fund at $5 billion in assets, because we won't let it happen.
Okay, so you got a fund, for example, like RBC Canadian Equity Income Fund. That fund, as an example, is about 25% energy. And the fund is about $4 billion in assets. So that's $1 billion in energy stocks.
Yeah.
How do you deal with an issue like that?
Well, that's all part of your job, Fred, and the individual investor's job. Do I want this? Like, if you're someone who thinks oil prices are going to go to $75 in a year, then you probably want that fund because you're going to do extremely well. But if you tend to be more of a conservative by nature, or you're a conservative investor, then that might be seen as a bit aggressive for any one individual fund to have that big of an exposure. But it also reflects the Canadian stock market, and the reality is a lot of our Canadian stock market is in energy. It's a big weighting in the.
So we get back to the situation, and let's talk about Canada as a place to invest. You got what is it? 60% or so of the Toronto Stock Exchange is made up of financial institutions and energy. Is that correct?
That is correct. Yes.
So
and then you throw mining on top of that, and you get higher. Yeah.
So the Canadian economy itself is not very well diversified.
Yeah. And I think that the Canadian stock market, like the Toronto Stock Exchange, is really not very well diversified. We do a better job with our overall economy, but the Canadian stock market is not very well diversified, and that's typically, of course, why a lot of Canadians historically over long periods of time have had a meaningful part of their portfolio invested outside of Canada to get exposure to some of those areas that aren't well represented here, like technology and healthcare and so on, that you find in an abundance of companies in the U.S. that are in those areas.
So if you overweight your portfolio in favor of Canada, then you're overweighting your portfolio in favor of energy and financial institutions.
You're
okay,
absolutely
so
right.
let's accept that, and let's pursue that. What's the outlook for financial institutions in Canada right now?
Well, on a long-term basis, I think the outlook for the Canadian banks remains very strong. If you look back to 1970, Canadian banks outperformed the Toronto Stock Exchange 71% of the time, the banks as a group.
Yeah.
So it's historically been kind of tough to go wrong in owning a Canadian bank, as many of your listeners and many of your clients know, and you know yourself, Fred. I would suggest to you there's always risks to any investment, and I guess the current risk, a couple of risks with the Canadian banks today are, number one, something we just talked about, how much of our economy, our country's economy, is exposed to energy prices, which are currently weak, metals and mining, which are currently weak. So how much of the banks lent to these types of industries? I can tell you for the Canadian banks, most of the Canadian banks have lent about 3 or 4% of their loan book is exposed to energy. So it's not huge. You can have problems there, but it's not a huge part of the loan book. Yeah. The other more recent threat to the Canadian banks' business model is what they call fintech, FINTECH, which is basically a fancy way of saying, what is technology going to do to traditional financial services? So, I opened my first bank account at the old Canada Trust when I was 4 years old. Okay, my mom took me down there, and I opened an account when I was 4 years old. My daughters are aged 10 and 12. Both of them have been in a bank branch once. And that was to open their account, and they have bank cards, and they basically, if you were to ask them, they would say, we really don't see any need to go into a bank branch. So things are rapidly changing, and one of the bank's great strengths has been, they have thousands of branches across the country to serve anyone in the smallest towns even, very simply and efficiently. But now, with the advent of fintech, maybe my daughters in a few years might just have an app on their phone and do all their banking on the app, and they would see no reason to go into the bank branch, and that opens them up to competition. So although the banks they have a very, very great competitive situation here in Canada, historically they've been great stewards of your capital. There's also some things to worry about with the exposure to energy and commodity prices in general.
And what about interest rates?
And interest rates, typically rates are so low in most parts of the world, Canada, U.S., Europe. The banks actually need interest rates to go up because if banks, to make a long story short, the banks will thrive as interest rates rise. So one of the reasons why banks have not performed as well in the U.S. this year is because in December everybody thought rates were going to go up in the U.S. roughly 4 times by the Fed, and now it's only 1 or 2, and so the banks have sold off because the profits are not going to be as high as everyone thought a few months ago, because interest rates won't be as high as everyone thought a few months ago. So the banks need higher interest rates, and they're just not getting it so far. It's a long wait.
Isn't it true that if interest rates go up, the banks have to pay more for their inventory?
Well, they do, but we're kind of in a curious situation right now where the banks are, the rate at which you pay deposits. Say a bank pays you 1/4 of 1% or 1/2 of 1% on your deposits. Well, now if they go out in the bond market, typically, theoretically, of course, they take your savings dollars and they put it, let's say, in the bond market, or they lend it out to people who need to borrow money. So they make a spread. So they'll pay a depositor 0.5% a year on their money, but they might charge a business they loan your money to 5%. So they make a 4.5% spread, if you will.
Got it.
But what's happened now is because interest rates are so low, maybe they can only charge that large company 3% or 2.5% to borrow the money, and they still have to pay the depositor 0.5%, because the depositor won't stand anything less than 0.5%, let's say. So right now the banks are only making a 2% spread if they're lending money to BCE at 2.5% and paying a depositor 0.5%. They're only making a 2% spread. But if interest rates were to go up substantially, let's face it, the bank's not going to raise your deposit rate, much above 0.5%, but they can turn around and charge BCE 5% instead. So now, if they can charge BCE 5 and only pay the depositor half a percent, they're going to get a 4.5% spread, and they're going to make way more money. Their profits are going to double.
So
normally,
in general right now, if you look at bank share prices, they've been declining for about a year and a half. What's causing that to happen?
Well, in Canada, the reason they've been declining are basically the exposure to commodities. People are very, very worried about the energy loans, the pure energy loans, the pure mining loans in the bank's loan books. But by extension, they're worried about maybe their exposure to people who work in the oil and gas sector in Alberta, who have a mortgage with the bank, who have a car loan with the bank, or a loan for a snowmobile or a four-wheeler or something like that. So people are very worried about the Canadian banks with sort of related exposure to commodities. And the other thing a lot of foreign investors are worried about is our sky-high real estate prices in cities like Vancouver, of course, and in Toronto here as well. They're quite worried about the risk to the bank's profitability if we were to have a significant housing market correction.
And what's the chance of that happening?
Well, you'd have to talk to a Canadian economist to get a better answer there, but I think it just boils down to interest rates. I mean, interest rates are so low that people can afford the monthly payment that coincides with an expensive home today, and that's just a function of interest rates. And
but needless to say, there's a lot of uncertainty when it comes to energy and banks or financial institutions, though.
That's correct. That is correct.
And that doesn't help, and hence the weak Canadian dollar and all the rest of it.
That's correct. It does not help. It does not help the Canadian dollar at all in a weak commodity price environment like we have right now.
Okay, Craig, we have to start winding up. Basically, what advice would you give our listeners?
Well,
so they can do better financially. What should our listeners do?
I think the one key thing I would highlight is that even today, Canadians do not have, as a group, Canadians do not have enough of their assets invested outside of Canada. And we've seen it come down from the peak in the year 2000. It's from 32% down to 8% 3 years ago. It's come up since then, but I still think Canadians need to have more of their portfolio invested outside of Canada. And as I say, I manage a couple solutions to that. Our 5-star rated NORP Global Income Growth and our new low-fee Core Global that can help them with that. But obviously, there's competitors out there. There's all kinds of ways that Canadians can get that exposure. But I think Canadians should have more of their money invested outside of Canada than they do today.
So the key word is global.
Yes.
Go global. Okay, Craig, I can't tell you how much I appreciate you joining me today, talking about financial planning, talking about the NOREP group of funds, and how they fit into the overall investment picture.
Well, Fred, thank you very much for having me on, and enjoyed the conversation.
Like to have you on any time, and we'll do it again.
Okay, sounds great.
Enjoy the rest of the weekend. Take care.
Thank you.
Bye for now. Ladies and gentlemen, listeners out there, we do have to go, and I'd like to thank you for joining me today and talking about NOREP funds. We'll see you same time, same station next week, and bye for now.
If you'd like Fred to review your portfolio, call his office right now at 604-737-3512. That's 604-737-3512.